What's the best way to avoid a financial crisis is a question a lot of investors are asking themselves today, and for good reason. Investors tend to be specialists. Venture capitalists invest in moonshots, real estate investors like real estate, stockbrokers like stocks, but specialists can miss the forest for the trees. If you follow only your area of expertise, you might miss the makings of a crisis playing out in another corner of the markets. That happened to a lot of investors back in 2007. They didn't see the trouble brewing with real estate until it was too late for them. There's no one better at bringing all the narratives of global markets together and assessing the risks that they pose than my next guest. I've had the pleasure of working side by side with John Mauldin for over a decade now, and he continues to inspire investors around the globe with his insights. Thank you for joining me for this week's Global Macro Update with John Mauldin. John Mauldin, always good to see you. Today on one of our chats, you were telling me about how there's not just one or not just a few things that really have you concerned globally. There's many, many things, many potential crises out there, and they're all interconnected. And I felt like that was something that we have to share with our readers and our viewers. So here we are. Thanks for joining me.
Here we are. I mean, I've been talking for quite some time now, what I call the Great Reset. And when I first started thinking at it, because I'm looking at the numbers and the U.S. debt numbers. I mean, I've done several letters on it. I mean, we're looking at $50 trillion by 2030, 2031. Especially if rates are in the 4% range, we just can't do that. So something will have to give. So that's like the big kahuna, and sovereign problems, debt problems in Europe, Japan starting to look like they're having some issues. China for sure, England, Canada. It's that sovereign crisis. Luke Gromen, a lot of people talk about it. I mean, it's just the tsunami of sovereign debt's going to hit here in another 3, 4, 5 years, 6 years. But as you get to thinking about it, let's look at what happened to COVID. We had some bad policy decisions, and now we've got inflation. That's not what we were looking at 2019. That's not what we were looking at even in 2020. The Fed's behind the curve, as my letter this weekend. This will have been the letter that people have just read. I'm talking about Powell's didn't get a jobs number that he wanted. He didn't get a JOLTS report that he wanted. I mean, there's nothing in there that would make me go, oh my God, he's going to pause and pivot, or pivot and pause, or do whatever. No, it was a very good jobs report. It's been trending down. It's been trending down for a year, but it still was 261,000. Okay, so I mean that's not a dog meat. I mean that's good. Those are good numbers. You need about 125,000. What was the old rule jobs just to maintain zero? Under this new regime, I don't know what it is anymore. Between the government and the Fed, and they've distorted the past numbers. So in the hundreds of times that I've said past performance is not indicative of future results, you can't model the future based on past. It's even more so today because they've changed the numbers, and they changed the base that we're pulling our model from. So, I mean, you can't assume we're going to get another COVID, for instance. I mean, you have this huge number. It's going to distort anything. If you take it out, then it distorts it because you get the bounce back. But the numbers going forward are going to be harder to predict.
How much do vacancies factor into this? Because our mutual friend Sam Rines over at Corporate Research He's been writing about how it's going to be a while before Fed actions show up in unemployment because prior to that, there's so many vacancies that have to be wiped out, essentially.
He calls it his VU number, vacancies
Yeah.
versus unemployment. And he makes a strong point that we have high vacancies now. I mean, it's higher, it's off of what it was, but it's higher than it's been ever still. I mean, if you don't take just the last little bit, we're going to have, I mean, jobs will start disappearing. That's what happens in slowdowns and recessions. But it's going to take longer than people would think for the jobs number to come back up. I mean, we had, under the household report, 300,000 lost jobs, 350 or whatever it was. And the unemployment rate only went up 0.2%. It's still at 3.7. It's still a very strong unemployment number. The problem we've got, one of the problems is that there's lots of things hitting us. I mean, energy is hitting us, and energy is hitting us again because of policy decisions. We're going to have housing problems because of monetary policy decisions, but we've made them unaffordable. We've taught a generation that you can get cheap money in a cheap house, and those have gone away. And if you got your house at a 3% loan, you don't really feel like moving. I wept a tear or two when I moved to Puerto Rico because I had to give up a 2 3/8 inch mortgage to get a 6% mortgage here.
Sure.
I hated that number.
To your point, there's an entire generation that doesn't realize that capital has a cost.
Well, I mean, I remember paying something like 14-15% on my first mortgage that I had. Mm-hmm. I mean, it was, and we could afford it, and we did it because it drove the prices of the houses to affordable rates. Inflation was 17, 18. I mean, I think we bought a house at 82. All of these things, the energy crisis, the housing, we just have too much debt. We don't have enough savings. I mean, all of this stuff is going to come to a head. Each one of them, other than the sovereign debt thing, each of the other things I've mentioned, could be solved in and of itself. It's not enough to bring the country to its knees. But what's going to happen, I think, is that when we get the sovereign debt situation, it's going to fall over into everything else. Now, by the middle to the end of the decade, we're going to have energy problems because we're not putting the capital expenditures into energy. We're not putting capital expenditures into mining. We think that somehow or another we're magically going to get all the minerals that we need to make all these batteries and solar panels. Well, just to get to the 2035 goals, we have to mine 5 times more lithium per year than we're doing now. That's something like 40 to 50 more lithium mines in the world, assuming that we can find the deposits that would be an average lithium mine. And, we've already found the really big stuff. Maybe there's a big one out there somewhere that we don't know about, but we've a lot of metals, cobalt, nickel. We found the easy things, the easy sources, and now we're going to have to start looking for more difficult places. We're going to need another 50 to 60 copper mines. These are big things. These take 8 to 10 years.
And John, are you saying that the policy moves that need to be in place aren't in order to facilitate this move?
I mean, what you've got is an ESG movement that says we don't want you investing in oil or gas, and we want to be environmentally friendly. Well, that's not mining. Nobody wants a strip mine in their backyard. We all want it done. I mean, it's like I just find the hypocrisy that we don't want to take Canadian oil through the pipe that we cancel, but we'll take Venezuelan oil. So we're going to give money to a dictator who's going to use it to oppress his people. rather than giving it to Canada, which is they've got the exact type of heavy oil that we need for our refineries.
Right.
Well,
Yeah, it does feel
Venezuela
like
used
there's
to
a
be our
massive
source.
policy disconnect. Michael McKee on Bloomberg reported when he was looking at the last month's jobs report that oil and gas, there's no capex happening in oil and gas. I mean, relative to history. And in fact, there was only 400 jobs added in that sector at a time when you've got the president basically screaming from his pulpit that energy prices need to come down. Yet we're not putting in
Well,
place incentives to do that.
90% of the offshore leases are, of the potential offshore leases are right now shut down. You can't get them from federal, let alone the state regulations. They say they'll let you lease on federal lands, but it's really difficult. I mean, it's not a real shock of announcement. I'm helping launch an oil fund, and we'll be drilling. But there's some states we don't want to drill in. I mean, there's some states that we do. There's lots of oil. There's lots of fields out there. You've just got to put the money together to do it. Right now, 60% of the drilling that's going on is private money. It's not the pioneers or the Chevrons. It's not the big guys. It's not even the medium-sized public guys. It's private money. They're looking at the numbers and they're going, this makes a lot of sense. If we're not going to drill enough, the price of oil and gas is going to go up. Now, during a recession, you could see demand suppression. Price could go down. In fact, I've talked to my partners. We would like to see the price of oil go down in the first quarter because we're going to be buying some fields. And, to buy a 10,000 acre or 20,000 acre oil or gas field takes a lot of money. Well, the price of that field will go down if the price of oil goes down. We'd like to buy cheap just like everybody else does and then drill and make it become more valuable. I don't know if we're going to get that pleasure.
So it's essentially, John, what you're saying, and I want to make sure that your views are represented fairly here, because you've also said you don't want to see the air that you breathe, right? And I feel the same way. We both have strong conviction about U.S. innovation and ingenuity. So I do think that there's an opportunity to decarbonize to some extent in this country.
Well, I mean,
but we're not making the moves to do it, and we're also not making the moves to have a transition. We're not doing anything, it seems like.
We're engaging in magical thinking. We think that somehow or another we're going to be able to build enough solar and wind to replace all of this, and batteries to replace all of this. Well, we don't have enough minerals to do it. We don't have the production facilities to do it. And temporary, the wind can go out, the sun doesn't shine. You have solar here in Puerto Rico, you'd think we get a lot of sun, but when you get a heavy, thick cloud cover, you're not getting nearly as much power.
Sure, you need base load power.
That's just the way it is. If you're really serious about taking carbon out of the system, then you're going to say, let's build fourth generation mini nukes. That just it gives you enormous amounts of power. It's remarkably safe. I'm just going to make a wild guess here, but the U.S. government runs 100 mini nukes. They're called
submarines.
They're called submarines and carriers and ships. Yeah. We could string, a few hundred mini nukes around this country, and we'd be carbon free in 5-7 years. The technology today allows you to actually produce them in one side, ship them, and then put them together, so that you can get scale to just basically pump them out and assemble them there at whatever your site is. It can happen a lot faster than people think. But you've got to have the will to do it. You've got to have leadership that says, yes, we're going to put, many nuclear facilities, and these facilities don't have to be, it's not going to be taking 1,000 acres. It's not. We don't have to have huge amounts of on-site water and all of that stuff. They're completely different.
John, I want to make sure we cover some of those other potential areas of concern that you mentioned. One of them being inflation. Paul Singer from Elliott Investments was recently out saying that he believes that the entire globe, is at risk of a hyperinflation crisis. What are your thoughts on inflation? You could argue that indebted governments are, to some extent, happy to see inflation.
I don't know that I know that I wouldn't argue for hyperinflation. I don't think it will get to that. Not in the U.S., not in Europe. And let me qualify that: probably not in Europe, not in the U.S. Europe's they're acting funny. They're doing funny things with their central bank. That being said, both of them know what to do if you get into too much of an inflationary mode. I keep arguing. I'm one of the few people that are now still arguing that Powell has to drive a stake in the heart of inflation, that he can't back off and pause or start cutting. Inflation is by far the biggest vampire in the room. It sucks out current earnings. It cuts out spending. It cuts out retirement. I mean, it just sucks it all out. You gotta slay that vampire. If we go the path we're going, we're going to have a recession. Yes, I think we'll see 5% Fed funds rate, probably 5% unemployment. But by the time we get there, we're now in the second quarter. The OER is going to start turning over, the owner's equivalent rent. It's all, in terms of the actual real-time data, it's already turned over, but it takes a year for it to filter in. Well, now we're going to start seeing negative rent, if you will, go into the OER number, and that's going to back it off a lot. I mean, probably 2 to 3 points over the next 6 to 9 months. The supply chain driven problems are going to be resolved because we're fixing the supply chain in a lot of places. We've gone from like $15,000 or $20,000 a container to $2,000 a container to ship from what little we're getting from China now. Prices are going to come down, and that inflation will roll over. But you got to be persistent. I mean, you've got to do what Volcker did, which is drive a stake in the heart, and then we'll get back to disinflation. We'll get back to stuff that we recognize. I don't know. I hope that we never get below 2.5% Fed funds ever again in my life. That would be really good.
So in your view, John, do you feel like even if you feel that the Fed was late to take action, are they now doing what they need to do?
Late, but yes.
Okay.
I mean, there's equal opportunity fingers pointing at each other. I think Congress is responsible for the bulk of the inflation with that last $2 trillion bill in 2021. That was what pushed us over. And I mean, Larry Summers came out and said, this is going to push us over. I did, other people did. It was a bridge too far, and the Democrats felt like they had to have it, so they did. And it was a straight partisan vote. But that, along with if the Fed had been leaning in already by that point, I mean, they should have been raising rates at the end of certainly early 2021. They could have taken $5 billion a month off of QE. Okay, not a lot, okay, but we're just going to take it. We're going to back it off. We're not even talking QT. We're talking Q, backing it off, raising rates. We wouldn't be anywhere near where we are today. It was major policy era. To some degree, I'd like to think it's not true, but you have to wonder if Powell was just waiting for Biden to reappoint him so that he could start raising rates. We'll never know.
Right.
And that's not going to come out in his bio. So
I wouldn't think so. So let's flip over to geopolitics for a moment.
Okay.
And you can't talk about geopolitics and global risk without talking about China. You made a great, fascinating point to me earlier that I hope to get out of you again on camera about China looking a lot like Japan did back in the 80s. What did you mean by that?
Well, for those of us who lived through the 70s and 80s, Japan was this juggernaut. They were buying everything. The Chrysler Building, Pebble Beach, just one thing after another, global, all over the world. And Japan also had a massive, massive real estate bubble. And when it burst, their stock market went down 40, 50%, or 60, 70%, still, hasn't caught back up. Japan didn't go away. It wasn't the end of their world, but it took them a while to sort things out. China has an enormous amount of real estate debt that's basically backed by the government. Now, in theory, it's not, but the government just can't. That debt is nearly all owned by individuals who bought investment products that are leveraged up and they pay, and people are looking for that return. They bought too much real estate. There's not enough income. They're in the middle of a COVID shutdown, so people can't make the money to pay for their houses, their second apartments that they've got. I don't know when they're going to let go of this COVID crisis thing they've got. That being said, Xi Jinping went too far. It was a big fight between the Beijing and the Shanghai factions. Shanghai faction wanted more business, wanted to be more out in the world, wanted to be part of the globalization movement. The Beijing group wants more top-down party control, wants more assimilation, if you will. Well, that brings up the concept of the Borg, but the Borg. It would not surprise me that China begins to have its own financial crisis within the next year or two. And that's not good for the world. They have been a monster part of the growth for the last 20 years. They've certainly been a monster part of the commodity complex. Something like 50% of the cement in the world went to China, the same amount of copper. All of that's going to back off a little bit because they're not going to be building as many apartments, as many homes and that type of thing. They'll still be building because they've got an entire western half of their country that's got to be brought up to scale, but it's not going to be anything like it has been.
You feel like there's a potential real estate debt crisis in Japan, or in China rather, and we had our own version of that back in '08, and ironically, it was China and China's demand and China stepping on the economic gas pedal that pulled the globe out of a major recession.
Mm-hmm.
Now you're saying that the reverse could be happening, but who is China this time?
It's not India. There isn't a China. The United States isn't going to be the United States in the sense of being able to recover the way we have in the past. We're going to have a recession. We'll recover. We always do. But we're not going to see 4 or 5% growth. We'll be lucky to see 2%. And that's not enough to pull, even if, as big as we are, that 2 or 3% is not enough to pull the globe along with us. It's going to, that's what I'm saying. This whole great reset, it's a global thing. It's a lot of factors going to get tossed into the bucket. the old, you find out who's swimming naked when the tide goes out. Well,
Right.
you also find out who's connected.
Right.
Okay, I mean, the connection. But what happens? We found out that subprime was connected to a lot of things that we just didn't think so. I mean, Bernanke, I think, when he said subprime is contained, he was looking at historical situations. Yeah, it was out of whack, but it wasn't going to bring down. When he was saying that, it didn't. I mean, my most pessimistic number when I was writing 6 months earlier than when he made that statement was I thought we'd lose 400 billion. And people were telling me, you know, I'm such a pessimist. I'm a bear. Turns out we lost trillions. I was the optimist.
Last thing that I want to touch base with you on, John, let me make sure I get this right. Axios recently reported a poll by the Benenson Strategy Group, which is a well-regarded polling group. They found that 44% of U.S. voters think the federal government is controlled by a secret cabal. So, John Mauldin, my question for you is, are you a part of this secret cabal that runs the government?
I can't confirm or deny that. I mean, I remember. Oh God, this was in the aughts. And there were people writing in letters, and they were serious about this, that Art Cashin and I and a few other people were part of the plunge protection team. And, you know, and I was writing, there is no plunge protection team, which of course meant that I was on it because I'm saying it didn't exist.
Right.
But there is no plunge protection team. There is no secret cabal. We're completely incompetent on our own without any help from some cabal.
They're not organized enough to have a secret cabal. I think that's the takeaway.
That would be the correct takeaway, sir.
John, as always, thank you, my friend.
Thank you very, very much for listening.
Thanks for checking out this week's Global Macro Update from Mauldin Economics. My name is Ed D'Agostino. Please be sure to subscribe to our YouTube channel, and we'll see you next week.